Deckers Outdoor, maker of popular brands Hoka and Uggs, got clobbered on Friday by 15%. That brings their year-to-date pain to 57%. I already had Deckers Outdoor in my watch list. And when a stock you're already watching goes down 15% in one day, it's time to roll up your sleeves and say, is this a value investment or a value trap? So join me for a 1-minute discounted cash flow analysis of Deckers Outdoor. Deckers is a simple business. They make Uggs and Hoka. The headwinds and reason for the big drop on Friday are tariffs, rising costs, and U.S. consumer softness. For example, they're expecting up to $150 million in extra cost of goods sold from Vietnam tariffs in 26. But Deckers Outdoor is a good business. They beat recent quarter revenues up 9% to $1.343 billion, and even they beat on earnings per share. But they pulled guidance. U.S. demand and direct-to-consumer channels are slowing in the U.S., but international is still strong. Here are my assumptions for modeling. I'm going to say that their revenue is going to grow 6% per year, gradually falling toward 3% long term. There will be some margin compression in the near term as they figure out the tariff situation, but then it'll stabilize. The company will offset a chunk of the tariffs via pricing and sourcing, but not fully. I'm going to put their cost of capital at 9.5% and the terminal growth at 2.5%. What I like is that they have two very strong brands with Hoka and UGG. And shoes are consumable. They go away after you use them, especially running shoes. And Uggs is a sort of evergreen lifestyle brand that makes the perfect gift. Buffett says to invest in things you understand, and this is a very easy business to understand. Their balance sheet is solid. They have great operating margins at 23.6%, which is high for this category of business. They have room for growth internationally. What worries me is that tariffs are a real impact to a business like this. U.S. retail demand may soften. They have real competition with the likes of Nike and On. But when I do my math of growth of 6% going to 3% on the base case, the margin of 22%, I get $112 a share, which is significantly above where it's currently at, and I put the odds at about half. And if growth is in the 10% range, I put the stock at $167 a share. So look, would I rather buy a intangible style business? My handle, after all, is the intangible investor. Would I rather buy a Google or a Microsoft? Sure, but price is what you pay, value is what you get. So I started accumulating on Friday. I will say a stock like this that's fallen that much will probably fall more. So I never do my full allocation out the gate. I actually hope it falls another 15, 20, 25%. They're also doing active share repurchases, so if the stock falls a lot, they're repurchasing. This could be a win all around. Because in the short term, stocks are voting machines. In the long term, they're weighing machines. And the Hoka and Uggs brands are intact for the long term, it seems, and this is going to be a cash generator. This is not investment advice. Let me know in the comments what stock you're going to look at next.